Hi friends, weekly stock market update into the new year, and this one's broken down into the rules that I'm using for my pensions. I want to give you a nice little update on the rules. Grab a pen and paper, make yourselves comfortable, and enjoy. Now, I want you to tell me where you're from, all the normal things I ask you, where you're from if it's your first time on here. And I will try and answer as many questions as possible. Welcome, Andy, Colin, Nigel, Mike, John, Barry, Stuart, Graham, Amit, Yorgos. We met in New York. Vasca, Janet, Michael, Jake, Jubin, Liam, David, Greg, amongst many others. Welcome, one and all. I'm going to put the chat on. Pinner, great. That means you can hear me as well. And let's get on with it. So, like I said, I've broken it down into rules. I think I've got more than 10, actually. Which are going to help and shape everything for the year ahead. And obviously last year was phenomenal, but I think the year ahead is going to be, well, I'll tell you what it's going to be because I'm about to explain what it's going to be. Newcastle, we've got Gummissel, Lee, any sound. Now, can you all hear me? Because somebody has just said any sound, so hopefully you can all hear me. Hi, Alpesh, Carl from Buckinghamshire. Greetings from New York, of course, Yorgos. I hope to see you very soon. Happy New Year to everyone as well. Let me know if the audio is good because somebody couldn't hear me. Malaga, of course. Graham, hope to see you soon as well. Forecasting. Remember, this is not individual advice. It's not solicitation to buy or sell anything either. Okay, we've got Clapham represented, all good, everyone can hear me. Ickenham. 2 million views, so good for the new year. In case any of you want some reading lists for before we get started, okay, this is what my wife got me. She didn't put them down like that under the tree. I mean, I laid that out. Stoic reminders. This one I'm looking forward to because she knows I'm big into behavioral science. But now I normally read about it in finance, but now she gave me the market equivalent, so it should be good. Peter Thiel, of course, is a big deal. Is Peter Thiel. So that's a really good book. So anyway, there you go. Bit of reading. Now, that's not mine. Actually, take it back. Mine's a green Lime bike. First rule. I am cautiously adding to winners. Everything is expensive. That's why I drew this picture. So I got this picture. It's got to be Dubai, doesn't it? It's got to be the Middle East. Everything's expensive, as I'm going to show you, and it's being increasingly driven by momentum. Now, that's not necessarily a problem, but what is the best strategy in those circumstances? And it reminds me of the time when the dot-com boom was happening, is you cautiously add to winners and you keep a close eye on things, hence the weekly updates. It doesn't mean you stay out of the market. That's the mistake a lot of people make. Oh, I'm staying out. And then, of course, it keeps going up and up and up, and they go, damn. Okay. Equally, I don't think it means you double down on absolutely everything. There might be periods like that during the course of the year, but at the moment, today, first week of January, let's cautiously add to winners is going to be the overall strategy. And this is an example of how expensive it is. You're paying $31 for every future expected dollar of profit in NVIDIA. You're paying $27 for Microsoft. Red is expensive. Financials are cheap, but growth is an important factor. This is why NVIDIA does really well and the others don't. You might say, given the growth of NVIDIA, that's actually cheap to be paying just that. We've got Cornwall as well. Greg said, reconnect doesn't help on there. What else have we got? Happy New Year, Joy Dev, and I understand Rolls-Royce have they done really well today? I'll have another look. They don't sell cars anymore, though, do they? Because Rolls-Royce is owned by BMW, and it's the engines they sell. Correct me if I'm wrong on that. Like the England football team, they're managed by a German. So some of the cheap stuff, some of the cheapest stuff, but we'll have a look at some of those. In terms of earnings calendar, things I want you to keep an eye out for is not that it's going to move the market, but just making sure these are meeting or beating earnings. Now, given that they're in financials and financials are cheap and financials should be continuing to do well, they probably all will. So that should be quite good for the market overall. Not that we're trading and gambling on their earnings announcements, but just letting you know what's happening. BMO means before market open is when they'll announce their earnings. Okay. Past week, not bad actually, given, we're about to, the EU and the United States are about to go to war against each other, joined by Canada. It's not bad. I'm just waiting to invade Denmark myself, which, people say, oh, it was very undemocratic. It's the most American of all things to do, to invade Denmark, not for the reasons you might think. I'm not talking about Iraq and all the rest of it. I'm going back 250 years, and I'm saying, well, you've got this native Inuit population, and you've got the American mindset of manifest destiny. Of course, you take their resources and their land. It's how America was founded. So why would you not take Greenland? It's a very American thing to do. And there's nobody more American, I'm sure he'd say it himself, than Donald Trump. So there we go. Communication services have done well. I'm saying it slightly tongue-in-cheek. Semiconductors, it's not been a bad week. Well, let's have a look. I mean, don't read too much into any of this yet, okay? We're not trading. We're here to invest. So we take a slightly further look back. Over the past year, well, that was great. And I think we'll get a repeat of a map which looks a bit like this over the next 2 years. As I've said, I'm not saying Amazon will be the one to go up 52%, but what I am saying is probably over the next 2 years, you'll get, say, Apple, Amazon up an average of 40, for argument's sake, okay? Surprised Microsoft hasn't done better in the past year, given it is very much an AI company, but I guess it's a reflection of how well it did the year before. And in any event, bodes well for the years ahead. Given how much these two have done, they might swap places with Microsoft for the next 2 years and only give us 14%, and Microsoft go on to give us 52%. Okay. I've been tempted to buy the new Microsoft Copilot computer, and they've not managed to sell me it yet. I've got the other ones. If anybody's got it, let me know if it's worth. I mean, to be honest, the other one works so well. I don't want to be sort of a bit of a child and just buy hardware for the sake of buying it. Nvidia 185% over the past year. I mean, it's nuts. And if you say to me, is it going to go up another 185 in the next year? I did a video on Telegram. I just realized that an old friend of mine is global head of enterprise sales at Nvidia. I'm thinking, Shankar, how's things looking? But I can't obviously say that or do that. Financials. Okay, I mean, look, a lot of green, not bad. We're happy. Exchange traded funds, for those who are on the Great Investments Program, you guys know that I put some more exchange traded funds. I did some analysis of ETFs, which have gone up last year, at least 15%, gone up over the last 3 years, over 50% at least. I think most of them went up 100%, and went up, sorry, not last 3 years, last 5 years have gone up over 100%. And in 2022, when the S&P fell, also went up. So I've done that. So if you're on the Great Investments Program, you've got that data. Okay. So not much to comment on ETFs. We'll have separate webinars for those. Are we expensive? Yes, we are. Price to earnings ratio. US, you're paying $33 for every dollar of profit in an American company. The average tends to be 30, so it's not that much different. However, here's what's interesting. Total market cap of US companies is now $63 trillion. Okay, that's the size of their economy, their GDP rather, is roughly, I think, 30 trillion a year. I keep forgetting. I should know this like this, but somebody Google it for me. What's the GDP of the United States? So the market cap, their companies are worth double, their listed companies, double what their annual GDP is. Their debt's about 30 trillion as well. So the market cap of their companies covers their national debt 2 times over in any event. But it's not really making a point there, anything specific. What I am saying is profits, that's the critical one. Of these 3 things, the most important thing is earnings. Earnings have gone up 10%, although prices have gone up 28%. So there's inflation there. Inflation isn't good. Price inflation isn't necessarily good. It's not necessarily bad. It just means things are getting more expensive. And you could get a pullback, okay? We don't know. We keep an eye on it each week. Here's the other thing. I've got some questions. I'll do those a little bit later on there. 29 trillion. Okay, so 30, 29. what's a trillion between friends? Okay, no sound. Greg, sorry you're having sound problems. Nicholas, obviously Bermuda. And Nicholas, I emailed you about the US ETFs. I'll get that done for you. Well, you and I'm sure, like you rightly said, other clients will be interested as well on the program. Total revenue, 22 trillion. Okay. And by the way, for those on the Great Investments program, you've got a detailed version of this webinar for you already on Telegram. So if you didn't want to watch this, you can just watch the detailed one. Okay, so don't worry, you don't have to watch this. Just so you know, this is more the public one. Total revenues went up 5%. Now, if revenues go up 5%, profits go up 10%, that means profit margins have increased. That looks good, all things considered, but as I often used to interview companies on Bloomberg TV and point out to them, wait a minute, you increase profit margins through short-term gains, which are going to cost you longer term. For instance, you might have just sacked a ton of people, reduce your wage costs, and these sales were already in the pipeline, got booked this year, and you're not going to get sales because you killed all your sales staff, for instance. So you showed a big profit margin, but it's going to cost you later. So what I'm saying is don't necessarily think, oh, that's wonderful. Okay, we'll keep a close eye on all of these things for you. It's just so you know the things I'm going to keep an eye on for you. In the US market over the last 7 days, the top gainers were these. Now, as you know, it's no secret. The public know this as well. I continue holding Amazon, Alphabet, Meta, NVIDIA. Meta that I'd got out of last April and then bought a little bit back into last month. I'd got out of it not because I thought it was going to fall, and this is an important lesson for you. People go, oh, Warren Buffett sold some Apple. He must hate it. No, it's because you're rebalancing because it had gone up X 100% since January 2023. And every time my son's portfolio sneezed a tiny bit with Meta, he was making or losing too large an amount compared to anything else he owned. So it's called rebalancing. Anyway, so have those. I haven't talked about that for ages, not even looked at it, even though it's gone up 100% in a year. So I probably should have looked at it, but it just didn't come up in our radars, which just shows you some things don't necessarily come up. Here's the interesting thing. You might think these are all tech companies. You're wrong. Apparently, this is consumer discretionary. It's not an AI company. You ask Amazon, are they consumer discretionary? What the hell's Amazon Web Services? Oh, that's discretionary. The amount of AI Amazon does. Anyway, this is a telecoms company. So is Meta. Did you know that? That's why I hate looking at sectors. It's such BS. And NVIDIA is the only tech company there. Oh, I didn't know Meta was a telecoms company. And Alphabet was as well. Anyway, so we'll do a deeper dive into these. And there's 3 things. What would you do if you're risk averse, risk neutral, risk loving with any stock? That's always the question to ask yourself. And the second thing you've got to ask yourself is, if you didn't own it, would you buy it today? If you already own it, would you hold it or do you sell it? Okay, so those are the questions. BHS, buy, hold, sell, write it down. Okay, and risk averse, risk neutral, risk loving. Those 6 things, buy, hold, sell, risk averse, risk neutral, risk loving, will help you make decisions a lot quicker when you work out, oh, this, therefore this. Boom, job done, move on. Okay, it's a good way of simplifying your decision making. The next rule for the year ahead for me, I think, is going to be, because the market's so overbought, and when it's overbought like that, it gets more turbulence, a bit like an airplane going through turbulence. So I'll probably be spending more effort on just throwing out more of these exchange traded funds, which tend to have lower volatility. As I said to the people on the Great Investments program, you have the extra data on those. On the exchange, and there's about 7,000 of these funds. I'm going to see in a second if I can show you without revealing anything. So, none of these I own, by the way, and they don't meet our criteria because they'd have to be green right across the board, all of these 5 columns. But as you can see, we will go through all 7,000 of them now. The ones on the LSE are the ones you can buy in Britain. The ones outside of Britain are the ones on the exchanges elsewhere. Okay, that isn't the same rule with stocks. This is with exchange traded funds. Their volatility tends to be a lot lower. Like that's 9%, but it doesn't meet our criteria. It's not good enough for us. That's 6%. So you can see the volatilities tend to be a lot lower with these than they do with stocks. However, and here's one which nearly meets our targets but doesn't quite, you can see even with low volatility, you can get your 18% in 6 months. That's not a bad volatility to have. So I'll be doing more on exchange traded funds going forward, because that's going to be, you know, for my pension, and I'll let the Great Investments Program people know what I'm buying and what I'm selling, but I'll give them the data on it as well. This, out of interest, is just the ones over the past month and performance year to date. I've not looked at these in any detail. It's just to give you a stock market update, because that's what this is. It might be that at some point I look at commodities. I don't know. Might do, might not. Might be that oil catches my attention. Might be that hydrogen does. I don't know yet. Okay, but it's just to show you what's happening in the broader market, what's doing well over the past month, and well, year to date is past week. Okay, so there'll be a deeper dive onto these, but it's been a busy week. I've not had a chance to dive into them at the moment. The past year looked like this. Now, the most important point to take into 2025 for my pension is a reminder also to my clients of patience. Actually, doing nothing is a strategy. Okay, in the stock market, it's the only place where doing nothing is actually a strategy. Auckland, Peter, hello. Auckland, thank you very much. Greg says now sound, so that's good, or no sound, I don't know. Okay, so that's 29%. What does it look like? And this is always the case with the stock market. And this is a really important thing to teach you, because by teaching you what I'm about to tell you, you're more likely to make a gain and not grab defeat from the jaws of victory. And by that, what I mean is, look at this. There'll be prolonged periods of 0% gains, prolonged periods of absolutely bugger all returns. Look at that. There will also be periods where all your gains go. Now, if you can't handle that, but you still want 29%, then you need to speak to the tooth fairy, because he's the only one who can help you. In the real world, sadly, a 30% return looks as ugly as this. It's like a nice juicy sausage, lovely vegan sausage, yet nobody wants to see how the bloody thing's made. Actually, vegan ones probably kills a load of plants, but you get my point. That's what 30% looks like. Flipping disgusting. Periods where all your gains go, you make nothing, you get frustrated, you get annoyed, you think, who the hell's this Alpesh then? And then you look back over the year and you think, oh, actually, I should have just kept quiet and carried on. That's what it looks like. And part of my job is to, well, I guess, get people sitting on their hands. Bill Lipschutz, in my book, Mind of a Trader, he was global head of foreign exchange trading at Salomon Brothers and hedge fund manager of the year a few years ago. Bill, when I interviewed him, I was in my late 20s, and I interviewed him in London and in New York, and he was one of the legendary traders of all time, one of the greats. Okay, still is one of the greats. And I interviewed him, and Bill said that most of the time you're just sitting on your hands. And I couldn't believe it. I thought, no, surely you guys are the hardest working people because you could bloody get paid the most. And he goes, no. I mean, it is one of the most disgusting professions is finance. Just don't tell the Labour Party, because we get paid for doing nothing so often. You would have got 30% for doing bugger all. I'm from Leeds. No wonder, you know, if people know too much about what I do, they'd absolutely hate me. I'm a London refugee because I was evicted from Leeds because good old honest people of Yorkshire said, "Ugh, you make money for doing nothing." Yeah, you know, welcome to London. Top 10 FTSE 350 stocks. They're these. That means the 350 largest UK companies. So that's the FTSE 100 plus the FTSE 250. Okay, 350 largest by market capitalization. That's what they did over the past month. Nothing for me to add. I might do a separate UK only stocks webinar for the moment. That's run by an acquaintance of mine. He wouldn't remember me, but I know him from the UK India Business Council. Sunil Bharti Mittal, not Mittal as in Lakshmi Mittal, no relation. Sunil Bharti Mittal. Airtel is an Indian company. There are more Indian companies listed on the London Stock Exchange than anywhere in the world, with the exception of in India. So outside of India, more Indian companies. Anyway, just thought I'd mention that. S&P 500. Now, this is the juicy bit. This is what you're all here for. Tell us, O wise one, wizard, with thy crystal ball, rub thy ball, and tell us which genie will appear from the lamp and what the future beholds. I swear to God, I'm teetotal. I'm doing this totally sober, and I'm not on medication. I probably should be, but I'm not. Okay, the S&P 500 is... And in case you're wondering what is this blue dotted line, let me know, by the way, in the chat if this is your first time. Richard's from Leeds. Yeah, we're top of the championship still, I think. I hope, I pray. So where are we here? This is where we are. Look. And that's a problem. It's a problem potentially. The monthly moving average convergence divergence, what that does is it measures the average price over the long and medium term. This measures it over the short and medium term, which is the weekly one. Anyway, let me interpret it for you. Bit of pattern recognition. That's all it is, pattern recognition. We look like we're near here. Now, we haven't fallen yet, so I don't need to exit. So the question is, buy, hold, sell, risk averse, neutral, or loving. Okay? Write that down, BHSANL. Okay? Because that actually might be a really good, what is that? It's not an acronym. It's, anyway, whatever it is, somebody more learned than me will tell me. Brain's going flat. So would I buy more? Now, I, as you may know, have the S&P, have 2 times leverage S&P, and have 3 times leverage S&P. So would I buy more if I didn't own it? No, because I am sort of risk neutral to averse at the moment, in the sense that it's a bit overbought. So I probably won't buy more than I've already got. If I didn't own it, would I buy it? Well, if I was risk loving, yes. If I'm risk neutral, you would go and add to winners. So you'd dollar cost average, you might put a bit in this month, another bit in 2 weeks or in a month, and so on, and adding to your profits. And if you're reverse, you never buy when something's overbought. So very simple. Loving, you go straight in. Averse, you don't go in. Neutral, you do halfway between the two. You add to winners. Add to winners is a hedge fund strategy, which again, Bill Lipschutz in Mind of a Trader taught me. By the way, for those who haven't downloaded a copy of Mind of a Trader, you can get it for free on my website and through my links. I will, at some point, I'll share the links with you. It's alpeshpatel.com/links. If you go there, there'll be one of the links which says Mind of a Trader, and you can download it and read it for free. It's an international bestseller for the Financial Times and myself, dare I say. It's thanks to that book I got flown around the world, including Guatemala, to give speeches and the like. Anyway, the point with this is, given where we are at the moment, you don't, and this is a really important point, what leads on from sitting on your hands. You don't say, well, it might fall, so I'll get out now. You don't prematurely exit, okay? Right? It's really important that people get that, because we don't know if it'll just continue going up and up and up. It might do. We don't know. Okay, and I'll draw some more images on the S&P. So that's how I'm looking at my pension at the moment, which is cautious trepidation, right? Now, if we get a baby bear where the MACD is rising, fine, I'll just stay in, I'll ignore it. Mama bear, where the MACD is falling, I'll stay in. Only where the MACD is falling from a height and it's a daddy bear would I exit, and that rule only applies to indices, okay? FTSE 100 seems to be going sideways, might fall, sometimes it bounces off the moving average, we don't know. If a recession's called in the UK, that'll probably help the stock market, because the stock market sees about 6 months ahead. It doesn't see 10 years ahead, obviously. It doesn't see 10 minutes ahead. It's too blinded. It sees about 6 months ahead. So it sees through a recession and that we're going to get out of it. So that's where we are. And yeah, it's the economy's, well, you all know which direction it's going on in Britain at the moment. So I would say we're probably going to get a recession this year on balance of probabilities, which would be good for the stock market because it'll look beyond it and go up. Top 10 S&P 500 stocks are these over the past month. That was the AI pick in March of 2023. Do you remember? It was one which had come out on AI. I put it on my private Telegram channel, and it was one which, had AI not mentioned it, I probably wouldn't have picked it out. But I saw, oh, I said, oh, okay. It was on our approved list as well. but I hadn't stood it out because of until the AI did it. So let's go through some of these and see what I think about them. One thing you need to know is a hell of a lot of stocks are overbought. That means that the momentum is like on the S&P. That worries me. What's driving their movements forward is not seemingly them being cheap, undervalued. We know that. It is not necessarily revenue growth, because I showed you that earlier with the valuations. Revenue or sales growth, sales and revenue is the same thing, was growing by a smaller percentage than was the price of the stock. So if it's not revenue growth, not valuation, it's certainly not dividend yields. Okay, dividends aren't going up compared to the price of the stock. What the hell is it? Well, it can only therefore be momentum. Okay, and that's not necessarily a bad thing. The best hedge funds in the world are momentum-based hedge funds. They don't look at value, growth, income, or anything else. They just look at momentum. People like Aspect, Winton, AHL, names you might not have heard of. J.W. Henry, who owns Liverpool Football Club, momentum hedge fund manager, makes you a shitload of money. Okay. I spelled momentum wrong. Apologies. So there's a lot of momentum. That's not necessarily bad. It's a little bit worrying. Okay. It means it's like running a car. I don't know what the analogy is. It's sort of a little bit worrying anyway. Everything isn't firing on all cylinders, but you can still be in it. You just got to be watchful, and that's my job, to be watchful. Okay, and the most watchful thing to keep an eye on is earnings. As long as earnings are growing, that gives us some support. As I showed you earlier, prices were going up, but earnings were going up. Ideally, you want earnings to go up more than prices, because then that gives you more of a buffer. Okay, imagine it's a company. You know, you'd want your profits to be going up even more than your sales, because then your margins are increasing, but you'd want the valuation of your company. Of course, you'd want it to be going skyrocketing if you're selling it, but if you're not, you'd want to make sure you're not overpaying. So my returns plan is ideally to be risk neutral and add to winners, i.e. edge in dollar cost average. Probably there'll be a few stocks which are not overbought. Sorry, that should have been not. Are not overbought. There's only a few which are not overbought, and I'll try and find those and invest in those as well. Okay, there's only a few which aren't overbought, and we'll try and keep an eye on those each week. Exchange traded funds, as I mentioned, will be a focus. I'll leverage on the few which are low volatility to the downside. You already know, and it's not news, that I have leverage on what I call my quality 5, the Meta, Microsoft, Apple, Amazon, Alphabet. Would I do that today? No, I wouldn't open new leverage positions if I didn't already have them in there, unless I was completely risk-loving. Actually, you'd only use leverage if you're risk-loving. Nobody on here should be using leverage because it's risky. Okay, and you've got to keep a close watch on these things. So that's where we are at the moment. That doesn't mean we're not going to make a return. It just means, and this isn't rocket science, it should be pretty bloody obvious, where it's going to be a bit trickier, okay, and a bit more harder work than last year was. But you know, is that doing anything than stating the obvious? I've just put a poll up of where you think the FTSE will be by the end of the year. Thank you, Sean. Gurpreet, thank you. Sean and the others, I will answer your questions in a second. So no worries. Elle, thank you for letting me know as well. Okay, so let's go through some of these, not all of these, which are the biggest movers over the past month in the S&P, just to make sure we're not missing anything. And Broadcom was one of those. That's, you know, I'm not telling you anything that you don't know, because you could look up what was the biggest movers. Okay, and this is typical of the problems that exist in the market, which is, you know, from this point onwards, it became overbought. How do we know? Well, it exceeded its previous high on the MACD, yet it kept rising. And a lot of companies are doing this. And that suggests it's either on growth or momentum. As I said, it just kept going up. And at the moment, for us, it's a 7 on value growth income. But because it's so overbought, if you're risk averse, you just wouldn't get into it. If you're risk neutral, you might edge in. If you're risk loving, you might go all in. Okay. But it's typical of what's in the market. Now, if you use this as a benchmark, then if you find other things which are like this, you might say, well, actually, you know what? I want the ones which are not too volatile. Look at this. It drops 22%. At least it's not 40% or 50 or 60. So not too bad. The risk is 22-ish. The reward on a continuation of an existing trend is 125. Well, 22 into 125 means you've got a reward to risk of 6 times, 5 to 6 times. Not bad. Okay. Other opportunities will be similar to this. Those on the Great Investments Program, have a look at the video on Telegram. This is included in there, as are others. Okay, there are other opportunities where, again, the MACD is a bit overbought, and we'll keep an eye out for those. Just on this broader point of the stock market update, for the last, 12, 18 months, I've always shown you Bank of America as a proxy for what's going on. And for the last 12, 18 months, it's done this, and it looks like it'll still sort of trudge on ahead a little bit more. I don't own this, just so you know, but it's just because it's a weekly stock market update. I'm just showcasing it to you. On the poll, 39% of you think it'll be higher, 42% think the FTSE won't be higher. Let me ask you another poll. Let's see what you think about the Dow. By Dow, you could answer it as US markets generally. Okay. So that's, what about Netflix? Again, one I don't own, but I've been covering since this period where there was some positive news. And after the news, I said, I'm going to start covering Netflix for you. I don't own it, haven't owned it since then. And since then, it's gone up 408, well, it's gone up 100%. Okay, but I covered it to make the point to you that when the MACD is rising, you can sometimes see on there. Now, it's not a 7, 8, or 9, so it's not a special situation for us. But if that trend were to continue, it would keep doing this. I'm not saying it's necessarily going to do that because it's now getting a bit overbought. So it'll be interesting to see what happens. If nothing else, it'll be a lesson in education. But this is the broader market. So we've looked at Bank of America. We've looked at this too that I don't own. But to say, where are we on the market? Well, we're not seeing sharp, short drops yet, but it's to give you a taster of what the market's doing. Another taster of the market is Mr. Warren Buffett's vehicle. Okay, not bad, only a 10% dip. Where are we on it at the moment? Well, again, it's overbought. Is that going to fall below there? Might do. I don't own this. Might do. But we keep an eye on it because it's a bit of a barometer, temperature of the broader markets. And at the moment, it's not particularly negative. It's not. But it's not particularly positive because it's overbought, but then it was overbought here as well. Okay, so it's a good one to watch in terms of, well, if we start going back up there, we'll be very happy because it suggests the market's going to keep going higher. Okay, the other rule I'm taking into 2025 for my pension is wait and watch others. And by that, I mean some of the hedge funds, because of the resources they've got, and see if any of the stocks they've got fall into my filter. And if they do, i.e. it's in my filter is the most important thing, but they also own it, then I will look to have them. I'll show you some examples. Equally, I won't jump prematurely out or in. Now, out means, look at the S&P. I didn't sell it thinking, oh, it's too expensive, because value is only one thing. And that's the mistake I'm seeing a lot of students make. Not students of mine, people make. They go, oh no, it's too, I'm not getting in. And I over the last 25 years at the various events I've spoken to around the world, the number of time I see people then come back to me and go, God, you know what? I sat on the sidelines and just missed the biggest opportunities. So I'm going to show you some of these examples anyway. In terms of the US markets, 81% of you think it'll be higher. Now, if you look at what's happening in the UK government and tax and growth, and what's happening in the US, loaded with billionaires who've said we're going to reduce corporation tax, we're going for growth, etc. Well, obviously, there's going to be a disparity. So British people with their pensions and their IFAs telling them to buy just UK companies and so on are necessarily going to suffer compared to the Americans going forward. I'm not necessarily over the next day or week they'll be that big. The gap will get wider over a longer period of time, which is why, as I've said many a time, in my first column in the Financial Times in 1999, I wrote how I'm getting out of UK stocks and only buying US ones. That's me at Cipriani's with one of our Great Investments Program clients, Joseph, at Grand Central Station. It was wonderful. I'm trying to think what we ate. We ate a lot of nice stuff and some chips. And thank you all. We haven't finished, by the way. The slides are in a. Thank you all for the comments over the last year and how you've been progressing and all the rest of it. So I'm really pleased of how things have been going. We've still got a lot to go through, so this is just a little of a pause. Hey, Alpesh, are you about after 1:30 p.m. sent an email to our community? Oh, Ravi, let me check. Sorry about that. I've just been absolutely swamped this week with just so much going on. 2 years of what equals price correction. Nav, not necessarily. Statistically, the answer is no. Statistically, the answer is no. 2 years overbought seems not to necessarily it, and it hasn't been overbought for 2 years. It's been overbought for 1 year, I think. So I'll have another check. Whenever you've got to be scientific about it. Winton Capital are one of the leaders in this field as a hedge fund. It's one of Europe's largest hedge funds. And what Winton Capital say is they take the scientific approach, which is they'll make a proposition such as you made, a hypothesis. They'll then test it against the data. That's the way it should be done. Unfortunately, with the stock market, what often happens is people say, well, this means that. I mean, they think of it the way they might a statement on Twitter, just randomly throw out stuff without any evidence. If you want to be successful at it, copy the best. One of the best is Winton, run by Sir David Harding out of Cambridge University, and they're based out of Hammersmith, and they're phenomenal. And they take that scientific approach, test the hypothesis. Now, once a bull market gets to 2 years old, there could be a lot left. Oh, there we go. Nav, you said it, and the slide came up. Bull markets, the past 50 years, that made it to their second birthday. Now, if I was a fund manager, IFA, or broker, I'd show you this, nothing else, and say, hey, guys, give me your money. Let's all go into this. Listen, it's going to be amazing. I don't have that conflict of interest with you. Because I don't have that conflict of interest with you, because I don't have that conflict of interest with you, I'll just tell you the way I see it, which is, yeah, statistically, there is evidence it could continue going up. I'd probably say 70% chance it will for the third year, but there's a 30% chance we get the pullback because it's overbought on momentum and there's just a lot of headwinds. I don't necessarily think the two NATO nations of Denmark and the United States, and well, basically, I don't think there's going to be a war inside NATO. But sometimes you wonder who's running America, Putin or Trump. Anyway, that's where we are with this. By the way, the whole Greenland thing, it's so Europe spends a lot more on defense. I mean, you've got two options. Guys, you need to spend a lot more in defense, otherwise the Russians are going to attack you. That's not working. Guys, you need to spend a lot more in defense, otherwise I'm going to attack you. And you tried it in the first term of saying, I'll pull money out. I won't give you defense. I might pull out of the treaty. That can't work again. That same threat can't work. Tell you what, I'll just take over your territory. That threat will probably work. And European politicians will think, shit, we better spend a bit more. Actually, they won't actually think that. What will happen is all the defense companies will say to them, like BAE Systems, guys, come on. And guess who's the biggest defense supplier in the world? They're all American companies. So those statements all are win-win-win. There's another reason why he's mentioned Greenland. It isn't just to get more people to spend. It's because after he won the election, he gets the daily national security briefing. And in that briefing, as he has alluded to, he said the Chinese and Russians are everywhere around there. He's got the briefing and he's worried about what the submarines are doing, what the flyovers are doing, what their ambitions are. And it's in a way almost a warning to the other parts as well, and telling the Europeans, you bloody need to spend more. Stop getting us doing it. Anyway, there's a lot of things going on, but he's not as crazy as people think he is, I don't think. Once a bull market gets to 2 years, there could be a lot left. Okay, there could be more left. I mean, that'd be amazing, wouldn't it? If we get another massive gain in 2025, I think we'll get 32% over the next 2 years. So I want my pension to go up at least a third in the next 2 years. Hopefully 40% a year. Woohoo! Wouldn't I be happy? But at least another third, because that's statistically what it does. But I take nothing for granted. Look at all these people. These banks have said this is going to be the total of the S&P. The S&P at the moment is about, what, 6,000? I think it's roughly around here. 5,900, is it? Somebody look it up for me, would you? Okay. Mark, I'll answer that question a little bit later on China and on your 2 points there. I think it'll help with the UK, as I said. If there's a recession, then it'll help to get something of a bounce back in UK stocks. But yeah, this whole thesis that we're cheap in and of itself doesn't help, because stocks don't move just on valuation, as I've shown you, because Nvidia is overvalued. How come it keeps going up? Because it also moves on factors, as we know from the academic literature, on growth. So those British companies being cheap alone doesn't make things move. If they're not, they might be cheap because they're not growing. They might be cheap because there's not enough income generated. There's poor cash flows. There's poor outlooks. So valuation alone, whilst it's an important factor and possibly the most important, actually growth has been a more important factor on the US side. Might not be on the UK, but so yeah, it doesn't, unless you can see the growth. Valuation alone is not supported by the evidence as a reason to purchase. Okay, so that's where we are. All these banks incredibly positive. Goldman Sachs said this, which probably sums it up, what I'm saying. It's very much on the one hand, but on the other hand, it's cautious entry. Okay. 59.18. Thank you for looking at that. 59.8. Yeah, so all of them are positive. I mean, of course they are. They've got to let it, clients they want to sell stuff to, I guess, but they do always generally tend to be positive. I think this sums it up quite nicely. Price targets, bull, bear, base cases. I don't necessarily have a problem with this. It's really the probabilities. 20%, that's fine. I can live with a 20% assignment to that. Okay, this is KKR, world's largest private equity firm. So they're not a bunch of dummies, let's put it that way. Okay, and that's the 60% case they're giving. I think you and I can live with that, can't we? Okay, because out of that, you know, if I've got my 2 times leverage and 3 times leverage in S&P and do nothing else, but just take the 3 times leverage on the S&P, I'd be bloody happy with that gain, wouldn't I? Of course I would. And that's without doing anything, without breaking a sweat. Forget the bullish case. Okay, I don't need to even be in individual stocks, because I'll have a tailwind and my stocks will have a tailwind. But yeah, this 20% is there. And I think that's a good number, saying 20%. Okay, I think this is a pretty good guesstimate of the market. If your IFA can't replicate this, then sack them. In the stock market, big years are common. Average years are rare. Annual returns for the S&P index over the last 100 years. Okay, more than 20%, that's how often. 10 to 20, that's how often. 0 to 10, that's how often. Sadly, IFAs want to put you into a spray and pray fund, and they just don't deliver, unfortunately. It's a lot easier than they'd like you to think. My job, actually, is to keep an eye out for any of these years like 2022. And when they happen, is to say to you, there's a daddy bear, the momentum is falling. Now listen to that. The exit in 2022, when I said hold cash, was based on price momentum. It wasn't based on, well, I've got a master's degree in economics and politics, therefore let me tell you what the future holds. It had nothing to do with it, because I knew from when I went for my interview at university when I was bloody young and had hair, I was already investing, and they asked me what my interests were. And my economics tutor said, you know, this won't help you, this economics degree, in your investing. And I said, yeah, I know that, because I'm investing before doing the degree and it's going all right, mate. So that wasn't it. It was momentum, which sounds stupid, but like I said, the biggest hedge funds in the world use momentum. They don't use all this macro stuff that you see on billions, which is there for dramatic effect. Because if it was a momentum fund, they'd be the most boring show on TV. So my job when we exited is to avoid these, and to tell my clients, hey, listen, cash, ease back. The momentum's turning negative, based on what I showed you earlier, mama, baby, daddy bear. UK debt crisis. UK debt costs highest since 1998. You might have seen this. That was this week. So the British government is paying more to service debt than it has in the past. And that's because when it goes out to the rest of the world to sell its debt, the people who are buying it, and I'll tell you who's buying it in a second, are saying, well, we want more money for it. We want more interest for it. If you want us to lend you money, British government, you need to pay us more interest. Okay, that's what the bond market is. You don't need to worry how that happens. But they say we want more interest, I want more payment. So the people who are buying it, two main entities that buy British debt. One, it's us. Okay, your pension fund is with pension companies and they go and buy British debt. So actually it's debt owed to ourselves, right? Same with America. Who owns American debt? One major category is their own people, which matters, but I'm just saying, okay? So that's pension funds because they know the British government's going to keep paying them and they know they're going to get a cash flow. Makes their maths really easy. We're going to get 5% for the next 30 years or whatever. Brilliant. That takes care of all those payments, liabilities we've got. They match the liability. The other group are obviously foreign countries, like the Americans will lend us money. I've got an image somewhere of who lends us the most money, but yeah, it won't trigger the far right. Okay, it's not. We're not quite what Rudyard Kipling would have. If I paraphrase him incorrectly, we're not quite the yellow man's burden. Quoting Kipling, not being racist. Be selective. This is what I'm going to have to be this year, more so than last year. Look for multi-year gravity-defying ETFs. So what I'm going to do more of is to look for not just the ETFs, but stocks which over multiple years have defied even when the market has had a headwind. And by the way, Nvidia isn't one of those, for instance, and neither's Meta, neither's any of the quality 5 actually. We're going to have to do a bit more data mining. Okay, and comfortable based on top of that, based on the volatility and whatever the thesis is, why have they been gravity defying? And out of 10,000 on a database, we might only find, I don't know, 50, 40 of those, which will be enough. But what I'm saying, it's going to be harder work, more data mining, and more difficult, I suspect, than last year was. And if it isn't, it becomes easy. Hey, icing on the cake. So here's an example. Okay, price over the past year, price over 3 years, and in 2022. Now, this is a crazy example. And I'm not going to get into these. I'm not planning to buy these. So what was there? And this is a very small example. There are actually better ones than these. But I'm giving it to show you that sometimes the thesis doesn't fit with what you want. Turkey. Well, are you all going to go out and buy some Turkish ETFs? Probably not. But it does show you political turmoil can lead. I mean, wasn't there a coup at some point as well? They have all sorts. I mean, they had massive inflation, interest rate problems, interest rates raised to whatever. Yeah, their currency collapsed. Which, by the way, their currency collapsing is probably what's helped all of this. Anyway, but so you're not going to do that, are you? Look at it; it's all bloody Turkey. I mean, there's some high yield bond thing going on there, but it's all been Turkey. Well, you're not. So it's not just about those numbers. We're also going to have to see: are we happy with the thesis, and something that we want to get into as well. Okay, this is going to continue happening. So obviously, I will keep telling you going forward about all of these awful funds and issuers. They're going to keep producing rubbish and they're going to keep underperforming. So just be warned. Look, if I say my job's going to get more difficult, that means they're going to get rubbish, even more rubbish than they already are. So just be careful if you've got. I pointed this out on social media and somebody said, yeah, it's not the provider you're worried about, it's the fund. No, St. James's Place produced rubbish. So did Fidelity, so did 91, so did the Baillie Gifford. And the reason is they're institutionally set up to produce rubbish because they've got so much capital because they're very good at marketing. You go on the internet and see how many times you see their adverts everywhere, okay, or on the tube or wherever else. Okay, so they're good at marketing and getting capital in, and then they have to divide that by country. So say to nice young man in their fund management office who's fresh out of university at the age of 22. And I know this because my secretary, who out of university started working for me 2 years after working for me, she joined Newton as a fund manager. Okay. And she was really good at booking my hair appointments, but I don't think I would have necessarily given her eventually 10 billion to manage. My point is, they'll take you even as a English language opera singer, which is great for giving opportunities to the young, but managing people's pensions and then this kind of stuff, that worries me somewhat. So the point is, they spray and pray and they tell you to put it into small amounts, and when the markets fall, they'll never tell you to stop paying them fees, will they? They'll say, no, keep your money with us. So just be careful. 10 biggest underperformers by fund size. Well, there you go. St. James's Place Global Quality Fund, Fidelity. So if you've got any of these, just be careful. Okay. If you've got any of these with your employer, just be careful, because the vast majority of them underperform. And I did some social media videos on this. And look at the size, billions, 10 billion. You've got 10 billion under management. And over 3 years against the benchmark, you're down 27%. Oh, where did that money go? Down 37%, 91. Bailey Gifford, 26. Anyway, it's great for me. St. James's Place failings are my opportunities. I'll let you have this document later, because what we do is different to what they do. We don't manage your money for a start. We don't manage, sometimes I get people saying, can I give you my money? And I say, I don't want it. First of all, you haven't got enough of it, so no thanks. I'd rather you kept it and grew it. We'll give you the data to grow it, but we'd rather you kept it and you grew it, because there's not enough for us to. I mean, unless you've got to. But if there's anybody on here who wants to give me 10 billion, yeah, I'll happily manage it. But short of that, no thanks. Anyway, IFA failings, there are advantages. They're low returns. They're traditional portfolios. I mean, honestly, they set a multiple choice exam to pass, and they get to call themselves an IFA. It is worrying how bad they are. I'll let you have that document. That's going to be accentuated even more, just as the difference between UK and US growth will be accentuated even more going forward. That underperformance of fund managers is going to get worse. Eugene Fama got a Nobel Prize in economics for explaining what I'm explaining to you, which is, if you give a group of people a lot of money to put into a small basket, they're going to underperform because they can't. It's like saying pick the England team from people who live in Watford. Okay, you're less likely to pick a World Cup winning team than if you say, hey, take 10,000 equities and filter down to the very best companies. Okay, so that'll make my life a lot easier, because it'll make me look better, certainly relative to them. But in absolute terms, I've still got to deliver an absolute positive return. I can't just say, listen, not as crap as they are. That's not good. You've got to deliver an absolute return. And when the fund managers and the pension funds fail, this is an explanation. This document's an explanation on why they fail. I'll let you all have a copy of this, because it's important you understand, given that that's who your money might be with. I'll also give you a copy now. We're nowhere near finished, but I'll give you a copy of the book Investing, my book, which was an international bestseller, which goes into all of this actually in detail. It's very readable. So I've put that up there as well. And I'll share a few other things actually whilst we're at it on there. Make sure it's there. I think that was on there. Okay, so another lesson, just keep an eye on earnings. Earnings are the critical factor which is going to determine whether this market keeps going up or not. Now, at the moment, US market outperformance is justified because earnings growth. They're making greater profits. It's actually getting almost exponential, the rate at which American companies, because they're becoming global monopolies. And under Trump, he's going to stick up for them. I think what had happened previously is there was a competition between the EU and the US who could fine companies the most, quickest. Because obviously, if you can find somebody a few billion, that's a lot of money for fat cats in Brussels to blow on luxury flights. Okay, so the Americans under Trump, well, think about it. Who's on his board? Who's around Trump? I mean, you got Tesla and everyone else. The EU starts finding Tesla. What do you think Trump's going to do? Sit back and say, yeah, you can do that to American companies? No, he's going to slap them down and start threatening. So I suspect their profitability should go up. I mean, we're not about to start sanctioning American companies. Jesus, we're addicted. Look at this. I'm on a Microsoft computer on Microsoft software with Apple computer stuff all around me and everything. Vasco, fantastic. Yeah, tomorrow the market's closed in the US. Lesson is going to be cautious optimism, know your risk profile. As I've said earlier, are you averse, neutral, or loving? If you're risk loving, you'd go all in. Let's say you wanted to buy Broadcom, you would buy it to your allocation of, say, $10,000 or whatever else it is. If you're neutral, you would edge in. You would add to winners, or you'd add every month, okay? If you're risk averse, you just wait if it's overbought, right? Wells Fargo, like I said, a lot of these, this is how they see things. That's their target. That's the average year ahead target. Now, I don't mean to be a pessimist. I mean, if I had a conflict of interest with you as an IFA, an IFA would say, come on, guys, give me your money quickly. I'm not going to say that to you. What I'm saying to you is manage your own money for a start. But what I'm saying to you is cautiously, we're going to have to work a bit harder to get our return, I think. Now, if I'm wrong and I don't have to work harder to get the same return, hey, we're all winners anyway. Again, that's Deutsche Bank and where they see it. Bloody hell. So, yeah, I almost sound like, well, I sound like a Yorkshireman. Bayek, looks like it might be a good year, the year ahead, but it might not, but it probably will. Bloody hell. So I don't mean to sound dour. They'll always come over for your pension. It's where the money is. So be careful. I think the UK government's definitely going to look for new ways of accessing the trillions. I think it's a couple of trillion which are in UK pensions. Because you come on. There's a couple of trillion, and you're not. That's people who own assets. Pensioners who have pensions have assets. We don't like people who've got assets. We want to take those assets off them and give it to people who don't have assets. Okay, how are we going to do that? Well, you've got pensions. I want some of that. Let me find a reasonable way of me getting my hands on that. That's coming. I'm not sure how, but it's coming. Oh, here we go. Now we know how. Sunday Times said 260 billion wiped from the valuation of assets in pension schemes. That was a clever way I didn't see. They just revalued it and said, no, it's not that. It's, move it from one column to the other. I already mentioned that, so I'm not going to go over that. This is the poverty gap, which is going to happen. Now, to me, all of this screams I'd rather be looking at global equities, including US ones. But look, US stocks aren't US companies. I hope you know that, because they export globally. Now, you might say, well, British companies do as well. Come on, be serious. They're global and they're usually well diversified. And even if they're concentrated in the US, it's the largest economy by a factor of 10 compared to the UK. What are we in the UK? No, we're 5 trillion, our GDP, and theirs is 30. Or are we closer to 3 in the UK? We're 3 or 5. I forget which. I think we're. Can somebody look up the GDP of the UK, please? I think it's either 3 or 5. I forget which. I think it's 3. Sadly. Okay, that gap's just going to get wider from what I can tell. Not necessarily this year. Might not be this year. As somebody said earlier, it might be a great time for the UK. Rarely on a one-year rolling period. I should have the data on this. On a one-year rolling period of the Second World War, when has the UK outperformed, let's say, the Dow or the S&P? Because the Nasdaq's not been that great a thing, as a thing for more than 25 odd years or 26 years. But over a rolling 5-year period, I don't think there's a single period where the UK outperforms the US since the Second World War. And anyway, what does it matter what happened in 1955? So what happens now? Okay, 65% over 2 years, not bad. If we get that over the next 2 years, as one of my students did, I'll be happy for him. I'll be happy for myself. All right, with all the headwinds going on. And that's why we're doing this. That's why we're doing this. So just to let people know. Oh, thank you, Ravi, my friend. I'm going to broadcast that. You're always very, 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 very kind. 2.5 trillion. Okay, so Britain is a smaller economy than that of India. All the countries could have had if we kept the empire. America, India, what the hell? Has your pension lost a fifth of its value? So again, look, if it's not the government, then it's going to be the fund managers doing it to you. right? I'm not trying to scare you. I'm just telling you, I think which way the wind's been blowing for a long time, you know, which now here it says give workers power to ditch pension schemes. I don't see the government doing that, even though it's a government of the workers. I see them taking it off the workers and saying, yeah, these things aren't working. Let us manage it. And we've already seen that because they're creating these super funds. What they've said is we're going to take it out of the control of others and have it centralized and let the chancellor control where the money is spent. It's just too much to leave alone. And anyway, pensioners don't vote Labour. So you're not even losing anything on the vote bank. Okay. And then, of course, you've got this problem, which is, now this is happening again now. When Liz Truss created a budget which the bond market didn't trust, the price of government bonds went down because the demand dropped, because the rest of the world said, we don't want to buy British debt. Looks a bit rubbish because this prime minister's and this chancellor's a bit not rubbish. So the yield, the interest rate you had to give people to buy it went up. You had to say, no, please buy it. I'll pay you more interest. I'll pay you more interest. Please buy it. Okay. That's happening again now. It's just that with Truss, it happened really quickly and it rebounded relatively quickly. Under the current chancellor, it's sort of more a slower death. Okay. But we're getting this again. What does that mean for pensions? It means pensions which own bonds, because that's what they own a lot of. The value of those bonds, the price of those bonds is going down. Now, that's all fine if you hold them to maturity. It's more a technical issue, this. If you hold it to maturity, it's fine, it won't matter. Guess what? That's not how they're measured. They're measured, what's the value if you had to liquidate today? And sadly, that means this. Okay? Aviva pension drops 20% in value. Wait a minute, pension shouldn't drop that much. Not when they're in bonds. What the hell's going on? So there'll be a bit of this going on, and it's happening right now. I might write an article on that, probably send it to The Guardian. Okay, so it's unfortunate. And on top of that, the right-wing press are also agreeing with the left-wing press. By the way, the only place in the media where the left and right agree. They don't agree on anything, anywhere, ever, except pensioners are getting screwed, right? That's the one place they agree. Okay, it's amazing. That you don't need to know. Drawdown danger. I'm expecting there'll be continuation of some of the volatility up and down, so just be a bit careful. What I want you all to do is you should, whatever you invest in, just monitor it. Have a look at the historic chart of it and look at the maximum drawdown. That means, you know, if this went up like this and then like this, that's a drawdown, peak to trough. Okay, is a drawdown, the maximum, the biggest of say the last 3 years, and just know what that is and what that would mean for a loss for you. This is one of my clients. They put this together. These are not things I own necessarily. It's what the client owns, and this is how they monitor it. So just be aware of the downside. Now you might say, "Oh, so boring, Alpesh. You're supposed to make me all excited." Okay. Somebody said 3.5 trillion. GDP, and somebody said 2.5. What's a trillion between friends? I think we're the 5th largest economy in the world now in the UK. I think the French are just about level with us. The Indians beat us, and then you've got the Germans, the Japanese, the Americans, and the Chinese ahead of us as well. If I'm not mistaken, somebody can look that up. Which isn't bad for a tiny little island off the coast of Greenland. They're coming for us next. Greenland's a staging post to invade Britain after he's taken Canada. Adult portfolio, this is how, and again, another one of my students did it. Last drop, potential loss if that happened, recovery time. This is not for any other reason than for you. It's not my portfolio, it's one of my clients. For you to have your expectations managed. Why? Because if you're going to sit on your hands, you're more likely to do so when you see something moving in the realms of, oh yeah, that's normal. Okay, and if you don't like some of those drops, then you'd go into exchange traded funds. But if you don't even know what these look like, then how can you decide whether it's individual stocks or funds, which are better? Okay. And you never know what he's going to bloody say. Between assassinations and his tweets or Truth Socials, I'm on Truth Social, but I've stopped using it. I just can't, too many social media. He wants Truth Social to be worth $1 trillion. He wants the cryptocurrency he's going to launch alongside Elon Musk to be, he wants to be a trillionaire and get the Nobel Peace Prize. Okay, just so you know. Broadcast, and one thing he hates about Carter, other than the Panama Canal deal, is that Carter got a Nobel Peace Prize and he hasn't got one, and Obama got one and he hasn't got one. Broadcom valuation soars past $1 trillion. We're still going to get some of these great opportunities. Okay, this you don't need to see. If you're not relaxed, that means you put too much into an individual stock. You should have put less in. You don't have the right data and you don't have the know-how. Usually it's all three for most people. 20 stocks. If you're risk loving, you'll have 20 stocks. If you're more risk averse, you'll have 40 stocks, equal amounts of money in each. Okay. If you are even more risk averse, you'll have less money in stocks and more in exchange traded funds and more in cash. If you're very risk averse, you'll only have a bank account with cash in it. Okay, so think of sliding scales when it comes to making decisions and say, well, which one am I on? Movie recommendation, The Big Short. He played Michael Burry, who called the market crash. I'm not calling it. I'm not saying there's a crash. I'll keep an eye on it for you. That's my best Michael Burry. If you're not relaxed, means you put too much money into an individual company without the data and the know-how. Okay, in which case you should have had more stocks and lower volatility ones, which is why I keep banging on about drawdowns. Okay, this is a long time ago. My son is about to turn 7. Back then, you could only put 4K into a junior ISA. So he was born in 2018. Okay, now I'm going to do a separate video on why my son's junior ISA is different to what mine is, or my SIP is, or my general investments are. Because with him, I take less risk. This came out because somebody thought, surely you take more risk with your son because he's younger. And I said, no, he's my son. I take less risk. Okay. By the way, he doesn't have Premier Oil at the moment or Glowbank, just so you know. That was then. That was then. And these are the kinds of returns I want for him in a year. And it's been a good few years, obviously. But I tend to have 4 or 5 things which I can leave and forget. You know, so if I've got 2 times leverage Apple, which he now has, amongst other things in there, I just leave it for the whole year. Okay, so in many ways, I don't put penny stocks in there or something crazy, which is what people think they need to do. All right. We're not taking crazy levels of risk. If you want to take less risk, i.e. less volatile stocks, that doesn't mean you get less returns. What it means is you have less choice, which means you've got to work harder, which is fine to try and find the right stuff. It means you've got to mine that data more. Now, everything I've told you, I've already mentioned in my various Financial Times columns. So, you know, if you want to download a copy of the book, you'll see the best bits of the columns in the book, which then tells you all the things that I've told you in this. That's when I had hair. 2024. This is a student who got in touch with me after what, bloody 3 years, to say 100 had become 400. He had added a bit, but 100 had become 400 in 3 years. And it took him, he's been quite busy. So sorry, had 2 babies, so I couldn't get in touch with you, but thanks, mate. Brilliant. That's what we're after. We're after that for people who've got children or, you know, who've got low risk appetite. Not just let's go buy some, you know, let's go get a newsletter and buy some bloody crazy penny AIM listed stock. No, it's got to be focused on low volatility, low, and even more so, I think this year, I'm going to have to be more observant than ever. And this is the other thing, and I'll tell you why. I'm going to show you something. In every 5 to 7 years, we have to hold cash. You know why? This is what happened to the Dow 30 stocks, the 30 stocks which are in the Dow Jones in 2008 when the stock market crashed, right? This is what happened. They all fell in, well, pretty much all fell in 2008, sorry. They all fell when the stock market crashed. There wasn't diversification, even though one is Visa and the other one is Boeing. Surely Boeing and Visa can't both fall, or sure, I mean, Walmart went up. Okay, well, would you put your money in Walmart? The one thing or 1 or 2 things that went up. So Nike, the shoemaker, fell 20%, but so did JP Morgan, which fell 27%, the financial company. Of course, they're diversified. So when your IFA talks bullshit about diversification, the academic literature shows, and I wrote about this in one of my FT columns, that when the market falls and you need diversification the most, stocks get more increasingly correlated to the downside, so they all fall in lockstep. So you don't get what you want. Okay, don't worry about this bit. This is where I get asked questions about what do you do when you've had a big gain. The bottom line rule is if it drops X, sell Y, and Y is dependent on your risk appetite. So we had quite a few emails, obviously, from people who've had some sizable gains saying, well, what do we do in that situation? It was just to say to them, I'm not going to go through all of these because otherwise it's going to take forever. But that's the important thing. You've got to make sure you've got some process for checking. Now, we do all the data for you if you're on the Great Investment Program, but if you're not, for whatever reason, then what you need to do is have some way of ticking the value box, the growth box, the income box, the cash return on capital invested, or some kind of cash flow measure, some kind of momentum measure, some kind of Sortino measure, which is statistically high average return, very shallow drawdowns and quick recoveries. That's what Sortino is measuring, just so you know. And Alpha is measuring, if the market goes up, you go up more. If the market falls, you don't fall as fast. So it's measuring resilience. Okay, these other things are less important, but they're the sort of very quickly the most important. This is from Goldman Sachs Wealth Management. Please have a look at it. Some people think it's a bit conservative. So if you think you've got 25 years to retirement, you might have 90% in equities, maybe 100%. You can take a picture of it. I'm not going to go into it right now. But please make sure you do look at all those factors. If you don't look at all the factors, you're gambling, because it means you've left information on the table and not looked at it, which means you've left room for hope, which is no place for your pension to be based on. Okay, unless you're with St. James's Place, in which case it's all based on hope and prayer. 20 to 40 is how many stocks I would suggest, equal amounts of money in each. I've written about it in the books you can get from down there. I'm going to answer the questions in a second. Johnny and everyone else, don't do leverage if you don't know how to do it. Do not do it. Okay. I will answer the question, but leverage is risky. It'd be completely irresponsible of me to suggest to anybody who I don't know do leverage, because it's bloody risky. Completely irresponsible for me to say. Links, that's where you can get the book. We'll also do, if you want, there's a free course material on there. You can download a copy of Investing Unplugged as well through that. One of the things that I think are increasingly reliant on this year, let's see, is the hedge funds which are doing 40% plus. We're going to cross-reference our picks with any of theirs and just see if what's on our filtered list is also held by them. If so, it'll give us a bit more. We'll hunt in packs. It'll give us a bit more confidence. Just because, like I said, the market's overbought, so I've got to be careful. The advantage why I say hedge funds are not fund managers, well, retail fund managers don't achieve those kinds of returns year in, year out because they're too rubbish. That's why they go to the retail financial industry. The hedge funds can also short things if need be and get out of them a lot quicker. They just have more liquidity and more access, and they can basically got more freedom to do whatever the hell they want, which is why they generate better returns. So we'll cross-reference our picks with those, and I'll share that going forward as well. We'll look at what the hedge fund ownership, this is an old one, so don't copy this. Reports are showing who owns what, and we'll cross-reference it with our list, just so we're double-checking, and we'll do it across all these hedge funds as well. In other words, what we're going to do is not just look at our database of value, growth, income, cash flow, Sortino, alpha. We're going to cross-reference and filter down accordingly, as my students know, with what hedge funds are doing. For that reason, that I think we have to work harder this year, I think, for those returns. So if you take a hedge fund like this, which was 51% return over the past 3 years, 51% per annum, we'll look at what they own. This is old, so don't copy this. And we'll see, are any of those on our list? And if they are, then we'll go, yeah, that gives us an extra degree of reassurance. So there'll be a bit of that going on as well. These, if you're on the Great Investments Program, you will have seen my views on these as well. We'll continue leveraging on lower risk stuff going forward. I think in this year, even more so. I think going in this year, just because I said the opportunity is being limited. Well, not limited, just a bit concerned about some of the opportunities. And that means statistically, we'll look to make sure that if we are leveraging, whether it's on CFDs or ETFs, and don't do leverage, I know I keep banging on about it, but we'll be looking for ones which generally have a high probability of being in a positive positive return over 250 days and not dropping too far in a short period of time, because otherwise that's 60% down. Because 2 times leverage would mean you're down 60%. You might only have a 1% probability, but that's why hedge funds blow up. It's why people go bankrupt. They borrow too much, i.e. they over leverage, it goes down, that once in a million year event happens and they're down too much. So don't do it. If you don't know what it is, don't do it. Okay. Blimey, no, it's too much. Our goal is this. If we can get 20% and we can double our money in 3.8 years. Now, some years you get 40%, 50% because the market's just that strong. Okay. If you want to see the performance over the last few years, have a look at alpeshpatel.com/shares. In 2022, it was 0%. When the market fell, we had to hold cash, just so you know. It was 0. So the other years have to make up to try and get us closer to that. That's what your bank will do. This is roughly what St. James's Place will do. Okay. We want to be down here, doubling the money a lot sooner. Now, if it doubles in 5 years compared to 3.8, do you think I'm that bothered? No, I'm not. Okay, but I'm certainly not going to sit by and put it in a bank account or with the St. James's Place or an IFA who will tell me it's going to be that. Okay, and why am I that confident of what my returns can be? Well, because over any rolling 2-year period since 1950, the average positive return is 32%. So let's just assume I don't F it up and do worse than the S&P, given that I own a ton of S&P and triple leverage on the S&P. It seems highly unlikely I'm going to get less than that, doesn't it? Okay, even if I get some stocks which hit my stop loss of 25% from entry, which some inevitably do every year. Okay, the ones which go up make up for the ones which go down, and that's what I'd be looking for. The other job I have is to make sure that on any negative year like 2022, we're holding cash and we don't suffer anything near those kinds of negative returns. Okay, that's one of my jobs. And my other job, I guess, is to make sure clients send me testimonials like this. That's from Trevor Atkin, one of our videos of these with the people are on alpeshpatelreviews.com. Oh, there we go. Now, I'm going to answer some questions. Over what period of time would you normally have to make decisions to go into cash? Well, in 2002, I guess you had about 3 months. And in that 3-month period, the S&P from its peak had dropped about 6%. So you lost 6% on the index. So you had 3 months, 12 weeks, where it was flashing up. Okay, now let's think about it. So it's not over a day or a week. So even if a client of mine didn't check their portfolio for a week or 2 weeks or 3 weeks or 4 weeks, they'd be fine. This isn't an advert for Barclays, even though they did my book launch. It's not an advert for Barclays. It's just to say, for those who don't have SIPs and ISAs, they're very easy to open. And if you want to learn about them, why not just go to the website of a Barclays or a Lloyd's or an AJ Bell or a Hargreaves Lansdowne? Because guess what? They pay people a ton of money to teach you and educate you about what a bloody SIP is or an ISA and all the rest of it. And they try and write it in very simple language because they want your business. So you just open one of those. It's like opening a bank account if you don't already have one. Please be aware then, once you've opened it, they will spam you to give your money not to you yourself to manage, but to give it to one of the funds that they get kickbacks from. Okay. Like Scottish Mortgage Investment, which lost 50% of your pension in a year. Because they will never, ever, ever in any circumstances tell you, just hold your cash and go give it, put it in a cash account, like in 2022. What they'll say instead is, keep paying us our fees. Our fund manager's really clever. He went to the right university, etc., etc. I have a better qualification than any of those fund managers. I can tell you now. No number of qualifications help when you've got a conflict of interest, which says to you, when the market's falling, if I tell people to sell my fund and go into cash, I'm not going to earn a living and my employer's going to sack me. So they'll just keep holding your money. That's corruption. That's corruption when they don't tell you in that period, get out of our fund because we can't go into cash. You can sell the fund and hold cash. It's corruption and they lose your fund. But there's no select committee, House of Lords or House of Commons select committee calling up the fund manager and saying, why the hell didn't you tell them this? Why did the IFA not tell you this? That's a pensions crisis. That's a pensions scandal. But in Britain, we don't get scandals. You know, Imagine that was a beloved institution, not that like our pensions institution, like the post office. We don't get scandals, don't get cover-ups. So we will continue looking at the hedge fund ownerships, wherever it is, like I said, just to cross-reference stuff. Globant isn't something I own at the moment, just so you know, and we'll do it across the data. I think it's going to be important. This was, well, it was a particularly good time, 2020 to 2021. 2022, we had to hold zero. So you go from 54. I think, Ravi, you're on here. That's the one. I always give the example where one of my students picked it from our list. This was the returns from our filtered list. He picked it. I didn't, because they make ugly shoes. He picked it. He got a great return. 2023 obviously was a good year. 2024 was a good year. Have a look at alpeshpatel.com/. Anyway, 40% come when there's a tailwind. We don't generate it. I didn't invent NVIDIA. I didn't create those returns. The market did. Croaky, for those who want to know it, this is from Goldman Sachs Wealth Management. That's 30% per annum is what stocks in the top 25% by cash flow on capital generate. The ones that generate the most cash flow based on their capital, the amount of money they invest, generate the most stock price movements up. And if you think about it for a moment, you can sort of see why. So we take their research, we steal their research, and we use that because they're cleverer than me, and they've got more clever people than me, and they've got more money than me to do that clever research. Okay. I've got a good, clever team, but my team are nowhere near as good as those people. And we've had some good. This is Bernard. Centaurus is a $2 or $4 billion hedge fund. That's Merrill Lynch. That's Coutts, Financial Times, BBC. It's, you know, I've been around long enough to get, you know, by the way, in those days you got those. Now, and this is on my desk, you get these from YouTube. This is the modern accolade. And that's from YouTube. If you go to my YouTube channel, you'll see why I got the silver one. It's based on followers. Some AI picks are there. We've got this. I'm going to go now. If any of you want access to both the calls with me and this, we don't do a subscription. My eventual goal is to float this as a challenger to a St. James's Place or an asset manager, in the sense that you keep your capital, we don't manage your money, you keep it, we give you the data and the know-how, and we don't charge you subscription fees. So we do the exact opposite of asset managers. You keep your money, we don't charge you a subscription fee like they do. We give you the data, they don't. We give you the know-how through video calls, they don't. So we turn it all on its head, so you've got all the control, whereas previously they've got all the control. Okay. And if you want to join, please do. On the webinars, I always make a discount available. And I take people in groups of 10 to manage. What I want to do, as I say, eventually get venture capital investment into it. And it's already global, but take it forward. We evaluate your portfolio with you, suggest goals. You put the holdings with whichever broker you like, and you can track it. And you always get access to me and my team as well. Sometimes people get shocked. Is it really with you? Is it really with you? Well, Ravi, I might be meeting you tomorrow by the looks of it. Go there. And Paresh, who was co-founder of a hedge fund, there he is. He'll give you a review of it all and talk you through it as well. If somebody's Hargreaves, I don't accept it. Charges are cheaper. Yeah, AJ Bell's there. You got Free Trade. You got Interactive Broker. Have a look at them. Interactive Investor. Have a look at them. So thank you all. Which platform should I move my pension to? Quilter will only allow me to have, well, this is it. Quilter, Vanguard, they'll only let you put money into their own funds. It's disgusting. They only let you put money into their own funds. I mean, not only do they have a conflict of interest, but they're actually handcuffing you. It should be illegal. In America, they'd get sued for it, for restrictive practice. In Britain, they get celebrated for it. We've got a lot of things wrong. If ever I go into politics, I think I'll specialize on the financial services industry and really give them a bloody good kicking on their conflicts. The way the grilling happened with McDonald's, pardon the statement, this morning about, you know, sexual harassment in the McDonald's workplace, and rightly so. CEOs should be grilled, but I'll be bloody grilling the IFAs and the asset managers on why they're screwing up your pension, because nobody else is doing it. So they're not equipped to. They don't know what the hell they're doing. So yeah, if you'd like to, do go along to that and do join up. I'm going to answer more of your questions as we go on. I've overshot. I always seem to overshoot recently. I hope you don't mind that I overshoot, because I do like to answer questions that everyone has got. Okay, let me answer the questions, because this is when the best bits can happen. Right, which platform should I move? Quilter will only allow it rather than individual equities. Are Hargreaves better? What I'd say is have a look at Hargreaves, Interactive Brokers, Free Trade, AJ Bell. Those are the main ones which keep coming up. I've got accounts with all of them. I have no issues with them. So I'd say have a look at those. If your stop loss owner, do you ensure your reward is 50%? Do you look at 1 to 2? The reward, by the very nature of the stocks we're looking at, we project forward over the next 12 months. And I'd want to make sure that there's two aspects to a reward. One is the probability. You see, you can have a reward to risk of 1 to 1. If the probability is 99%, for argument's sake, take a theoretical extreme example, 99% is going to go up, then what does it matter that the stop loss is 25% and the reward's 1 to 1? Because probability is a relevant factor. So the reason we look at value growth income is because that's another way of saying what's the probability of direction. It's not about the size, it's about the probability of direction. So we're assuming already the probability is high, and then we're looking at the projected trend that it's already on, and we project that forward and say, is that giving us at least 40? Given 40 times a probability of, say, 0.7 is greater than 25 times the probability of 0.3, you can see how your calculation, whilst rudimentary, is sort of correct. Ours is a bit more sophisticated. It's size times probability. Okay. The reason, by the way, yours fails, and you'll have read this somewhere, I'm sure somebody somewhere on the internet said, make sure you've got a 2 to 1 reward to risk ratio. The reason why your calculations fail is this. Pick a random group of 10 companies and put a stop loss at 25% and a gain of 50. So you'll exit if it goes up 50 and it stops at 25, or even do 25 and 12.5. So you've got 2 to 1. You will actually lose money. And the reason you'll lose money is because half of them will go up, half will fall roughly, and you'll have lost. Okay. You can do it without real money. So that's the extent to which markets are random, and that's why we go to all the trouble of looking at value. Otherwise, we just simply do this. We just say to you all, "Hey guys, pick 10 stocks out of a hat, put a take profit at 50% gain and a stop loss at 25. You'll all be making money because you got a 2 to 1. Without probability, it's meaningless." Okay, is value approach different to day trading? Very much so. Day trading is completely different, Amit. Totally different. Trading and investing is completely different, two different things. Day trading is holding things for a day or two. If your employer matches the pension contribution, can I still open a SIP and still receive the employer contribution? If you look on a website like Hargreaves Lansdowne, they'll actually explain to you that yes, you can is the broader answer, or a Barclays. However, ask your employer first if they will match the contribution into a SIP. They should, because the cost to them is no different. But if they don't, then you might think, how much am I losing in their contribution? So find out what their contribution is and how much more might I make. There's no point in having an employee contribution if your fund manager is getting you a 0% bloody return. Okay, there's no point, is there? So speak to the employer first, work out whether they'd do it. Have a look at a Barclays or a Hargreaves website, which will explain very simple, great terms. And you'd even be able to talk to them and call them and say, listen, my employer's doing this. This is who they are. What do you think? Because they want your business. They'll say, yeah, well, this is what you do. So this is part of everything that we offer and give people. And that's it. And that way you get the benefits of it all. So like I said, if you'd like to, the other thing to have a look at is, if you look at that website, you'll see some free resources there as well. Pensions tracking global equity index. Yeah, that's fine. That's relatively low risk. Nothing wrong with that as in and of itself, but you might have wanted a bigger gain. Do you see what I mean? The problem about tracking a global equity index is nothing overtly wrong. It's well diversified. It's global. How nice is that? But you might have wanted a bigger gain. And that tends to be one of the big complaints people who come to me have. They say, well, I don't like the returns I'm getting. But if you're happy with the returns, so be it. What are my thoughts on Chinese stocks in 2025? Lots of value will tide turn for Chinese stocks. Well, in very broad terms, Mark, there's two ways of accessing the Chinese market in broad terms. Well, it's three. One is you can open a Chinese account in yuan and access the Shenzhen B exchange. That's less likely something you're going to do. The other two ways are either exchange traded funds, which track China, and we haven't seen those names pop up on our filters, which might be that they're not as good as you think, or ADRs like JD.com, which are listed on the US stock market. So Chinese companies listed on the US stock market. So in terms of broad comments, yeah, I could say to you, yes, it looks undervalued. I can give you 10 reasons why it might. We tend not to look at narrative. We look at data. When we look at the data for companies like, say, an Alibaba or JD.com, we wait to see, is it undervalued? Have we got high growth? Is this so we look at specifics, not hypotheticals and generalities, because hypotheticals and generalities don't pay the bills. A specific one does. And the specifics with those is, yes, there are one or two companies where we've ticked some boxes. Absolutely. Not on the exchange traded funds, I'm afraid, but on the individual companies listed on the New York Stock Exchange. I wrote about ADRs in my FT column many, many moons ago, and it worked out really well. That these ADRs give us an opportunity to open so much. Hargreaves been taken over by a private equity company, new chairman, possible ex-Sky Bet guy. Yeah, when private equity takes you over, we have a private equity firm, my fund. The prices are going up, okay? Just so you know. The private equity means prices are going up and there'll be more aggressive marketing, and they will market to you more of their funds because they earn more from that. They don't like it if you're self-invested, but that's so what do you care? It's a bit like going to the cinema, and they might not like it that you didn't buy popcorn. Well, tough shit, you paid for the seat, you've got it, that's their loss. So what else have we got? Be a good amount to start investing. Would there be an amount? Well, if you've got less money, you can probably only buy one stock. I mean, if you've got so little money, take a sliding scale, you can buy one share of one company. From what you're telling me, Amit, have a look at free trade, okay? Because you can buy fractional shares, I think, on there. So do that. I tell you what, if I've missed any others, just write them at the bottom again. Otherwise, I will leave it at that. If you'd like to have a tour or reserve a space on the program, just message or go to alpeshpatel.com/links, okay? Because on there, Paresh will have a video call with you, as indeed I can. Tower Watson, yep, famous company. It's a big famous company. They're not going to look. They're not going to steal your money. We can pick from about 40 different ETFs, but not individual stocks. Am I losing out? It's such a difficult question. 40 different ETFs worries me because they're only giving you a restricted look. If they said we don't want you in individual stocks because of some conflict of interest because you work in a bank, you can only have ETFs, I'd expect them to open up the universe of ETFs. Okay. So it might be worth asking why. It might be that the 40 that they're putting you in are some of the pretty good ones. But in a way, let me answer it this way. If somebody said to me, I can only pick people for the England football team from Watford, not throughout the UK, am I missing out? Well, statistically and probably, yes. Okay, so statistically and probably, yeah, you can only invest from 40. You've got to pick from a fewer bunch than a bigger bunch. Yeah, you are. Is it more tax efficient to put your money in an ISA rather than a SIP? It's in broad terms, it's the same. They both are tax free, but there are differences in the sense that I'll give you an example. If my company puts money into, so I own my own company, puts it into my SIP, that's an allowable expense for my company. I get, basically it's equivalent of if I put capital post-tax earnings in, I get the tax I paid on it back, goes into the SIP. In an ISA, it's tax-free gains just like in a SIP, but I don't get the government adding to my ISA through the tax I've paid. Does that make sense? Okay, so and the best place to get that explanation is, like I said, if you go to Barclays, they'll explain it to you on their website. I've done a slight explanation there. So in a way, perversely, a SIP is more tax efficient, but you're locked in longer to retirement than an ISA. But they're both equally tax efficient in the sense that all gains within them grow tax-free. However, when it comes to withdrawing, there's no penalty on withdrawing from an ISA, but you might have to pay tax on your gains on a SIP. So there's a bit of swings and roundabouts depending on how much you've got in there and how much is going to grow and for how long. There can be scenarios where the SIP works out more tax inefficient than ISAs. I probably can think of some scenario, and there's others. Ideally, you want both, I would have thought. But to specifically answer that, I would say just have a look at one of those websites. I'd also say, if you feel more comfortable and you think you might need the money out sooner, then put it in an ISA. Is one way to do it. I also put mine into my plan with the employer matches. So I also put one into a SIP. What's the contribution to stay within the fairly generous limits? Tax rebate. Exactly, tax rebates on your contributions. Like I said, the best places that explain this to you, because they're rather good, is, and I keep mentioning Barclays. Honestly, I have no affiliation to them, but a Barclays or HSBC, they're very good web. Think about it. They pay people thousands to explain things in simple terms. Another place always is to get good explanations is Money Saving Expert as well. That can be quite trustworthy to get explanations as well. I'm also going to make sure I've sent you all the files I wanted to share with you as well. Just make sure you've got everything there. Okay, I'm going to leave it at that because it's 10 o'clock. I've overshot again. I'm really sorry I've overshot. If there's any more questions, thank you, AD. If there's any more questions, would you just email me, please? And that'd be helpful. If you'd like to look at the free resources, it's alpeshpatel. Oops, there you go. You can go there, campaignforamillion.com. We've got quite a lot of business owners on the program, which has been nice to see and interesting for me, because I guess business owners understand companies, but they also like the fact that they're used to being in charge, and so they like the fact that they're also in charge of their money because they're managing it themselves, and we're giving them the tools to be able to do it. Okay, thank you everybody for being on today, and I'll try and do another one of these very soon for you. For all the people who signed up, thank you very much. I will send you an onboarding email and we'll have our first call, and you'll get access to the database and have a call with me to educate you, well, as early as tomorrow, I guess, but you get the email tonight. Thank you all very much indeed.